The Magnificent Seven stocks have dominated the market for years, but in 2026, something interesting is happening. These companies are no longer moving together. While some are surging thanks to artificial intelligence, others are facing rising costs, competition, and slower growth. Collectively, these seven companies are sitting on nearly $600 billion in cash, giving them enormous power to invest in AI. So, in this video, we're breaking down the bull and bear case for every Magnificent Seven stock, starting with the company that has become the face of the AI revolution. Let's start with Nvidia, which many investors see as the clear leader of the AI boom. The bullish case is simple. Nvidia's GPUs remain the backbone of artificial intelligence infrastructure, and major cloud companies are expected to spend hundreds of billions of dollars building AI data centers. That demand has helped push Nvidia's revenue and profits to incredible levels. But there's also a growing bear case. Nvidia's market value is now so massive that maintaining its previous growth rate could become extremely difficult. Critics argue the company would need nearly $200 billion in annual earnings within a few years to justify current valuations. So while Nvidia remains the king of AI chips, investors are now debating whether the growth story can continue at this pace. Now shifting to Apple, the world's most influential consumer technology company. The bullish case revolves around Apple's next generation of AI-powered devices. Reports suggest the company is preparing new products designed around on-device artificial intelligence, which could spark another major upgrade cycle for iPhones and other hardware. Institutional investors continue to show strong confidence in the company, but there are also risks. Apple still relies heavily on manufacturing in China, and tariffs or geopolitical tensions could pressure margins. At the same time, regulators around the world continue to scrutinize Apple's tightly controlled ecosystem. So while AI hardware could drive the next wave of growth, external pressures remain a major challenge. Next up is Alphabet, the parent company of Google and one of the most powerful players in artificial intelligence. The bullish argument is that Alphabet may actually have the most complete AI ecosystem in the world, combining research, massive data sets, and global cloud infrastructure. The company also has over $120 billion in cash, giving it enormous flexibility to invest in the future of AI. However, some analysts worry about what's known as the AI circular revenue problem, where tech companies are mostly selling AI tools to other tech companies rather than to consumers. If that dynamic doesn't change, parts of the AI market could eventually cool off. Now let's talk about Microsoft, which has become one of the biggest AI investors in the world. Some investors now see Microsoft as a potential value opportunity after recent pullbacks in the stock. The company is aggressively expanding its AI infrastructure and cloud services, positioning its Azure platform to benefit from long-term AI demand. But there's also a major concern. Microsoft's spending on AI data centers could reach nearly $200 billion over the next few years, which may pressure profit margins in the short term. So while Microsoft may ultimately emerge as one of the biggest AI winners, investors may need patience while those investments play out. Moving on to Amazon, which is rapidly expanding its position in the AI infrastructure race. Amazon's cloud platform, AWS, is forming major partnerships in artificial intelligence and developing its own custom AI chips like Trainium and Graviton. Those chips are already generating billions in annual revenue and could reduce reliance on outside suppliers. But Amazon is also juggling a huge number of massive projects at once, including retail expansion, logistics, AI infrastructure, and satellite internet through Project Kuiper. That complexity could create execution risks if the company spreads its resources too thin. Next is Meta Platforms, which has been quietly using AI to transform its core business. Meta has dramatically improved its advertising systems using artificial intelligence, helping drive engagement across platforms like Instagram and Facebook. The company is also developing new versions of its Llama AI models and exploring monetization opportunities for platforms like WhatsApp and Threads. But some investors worry Meta could fall behind in pure AI innovation compared to companies like Nvidia or Microsoft. There are also questions about whether the company's huge infrastructure spending will generate strong long-term returns. Finally, we get to Tesla, one of the most debated stocks in the entire market. The bullish argument is that Tesla's future could extend far beyond electric vehicles. The company is rapidly expanding its energy storage business and developing new technologies like the Optimus humanoid robot. If those initiatives succeed, Tesla could become a major AI and robotics company. But there are also serious concerns about the core EV business. Competition from Chinese automakers is increasing, and Tesla's global market share has been under pressure. That leaves investors wondering whether Tesla's future will be defined by robotics and artificial intelligence or by challenges in the electric vehicle market. So the Magnificent Seven are no longer moving as a single group. Some companies are dominating the AI infrastructure boom, while others are navigating rising costs, regulatory pressure, and increasing competition. But one thing is clear: artificial intelligence is shaping the next decade of the tech industry, and whichever of these companies executes best could become the next trillion-dollar growth story.